Magnificent Seven no more. Investor exodus threatens tech sector supremacy. The once unassailable reign of the Magnificent Seven, Apple, Amazon, Alphabet, Google, Microsoft, Meta Platforms, Facebook, Tesla, and Nvidia in the realm of exchange-traded funds, ETFs, is facing a growing challenge. Concerns about a potential technology bubble, coupled with a thirst for diversification, are driving investors to explore alternative investment avenues, siphoning away precious inflows from these tech titans. This tectonic shift in investor sentiment has the potential to reshape the landscape of the ETF industry and raises critical questions about the future of big tech itself. The allure of the Magnificent Seven. For years, the Magnificent Seven mesmerized investors with their seemingly unstoppable growth trajectories and skyrocketing valuations. Their dominance in key sectors like cloud computing, social media, e-commerce, and electric vehicles fueled an unprecedented inflow of capital into tech-focused ETFs. These funds enjoyed immense popularity, drawing in both sophisticated institutional investors and retail traders seeking exposure to the digital revolution's golden boys. The rationale behind this infatuation was clear. The Magnificent Seven possessed undeniable competitive advantages, strong brand recognition, and seemingly limitless avenues for expansion. Their stocks consistently outperformed the broader market, generating outsized returns for ETF investors who hitched their wagons to their meteoric rise. However, this idyllic scenario could not last forever. Cracks in the facade. The whispers of a potential bubble in the tech sector began to grow louder in late 2022. Valuations, fueled by soaring stock prices, reached historically high levels, exceeding fundamental benchmarks in many cases. The breakneck pace of growth seemed unsustainable, and cracks began to appear in the seemingly impregnable facades of the Magnificent Seven. Macroeconomic headwinds, such as rising interest rates and inflation, further added to the unease. Investors, mindful of the historical tendency of technology stocks to be disproportionately affected by economic downturns, started questioning the resilience of the Magnificent's dominance. The tipping point came in the second half of 2023. A series of disappointing earnings reports, coupled with negative news flow around regulatory scrutiny and market saturation in key sectors, triggered a wave of profit-taking in tech stocks. The Magnificent Seven, once invincible, experienced significant share price declines, eroding investor confidence and prompting a reassessment of their investment thesis. The rise of the skeptics. As doubts about the technology bubble solidified, investors began to look beyond the Magnificent Seven in their ETF choices. Alternative strategies emphasizing diversification, value investing, and exposure to emerging markets gained traction. Thematic ETFs focusing on sectors like clean energy, healthcare, and infrastructure received increased attention, offering investors exposure to growth opportunities less vulnerable to potential tech sector implosion. Furthermore, the rapid growth of actively managed ETFs offered investors a chance to benefit from skilled fund managers' expertise in navigating the turbulent market conditions. These active funds, with their ability to dynamically adjust their holdings, provided a welcome contrast to the static nature of many traditional, passively managed tech-focused ETFs. Consequences of the shift. The siphoning away of flows from the Magnificent Seven has significant implications for both the ETF industry and the technology sector. For the ETF industry, this trend presents both challenges and opportunities. The dominance of tech-heavy ETFs had fueled immense growth, but their decline necessitates diversification and innovation. The rise of alternative strategies and actively managed ETFs demonstrates a demand for more nuanced exposure to the market. ETF providers must adapt to this shifting landscape by developing new products, catering to investors' diversified needs. For the technology sector, the reduced ETF inflows could indicate a slowdown in growth, impacting valuations and potentially forcing strategic retrenchment. However, this could also be a healthy correction, weeding out unsustainable business models and paving the way for long-term, sustainable growth. Uncertain road ahead. The future of the Magnificent Seven and their role in the ETF landscape remains uncertain. While their immediate dominance may be waning, their underlying business fundamentals and long-term growth potential should not be dismissed. The current market correction may be a temporary hiccup, or it could signal a more fundamental shift in investor sentiment towards the technology sector. Regardless of the outcome, the siphoning away of flows from the Magnificent Seven serves as a valuable reminder of the dynamic nature of the market and the importance of diversification in investment strategies. Beyond the headlines, a deeper dive into the tech exodus. The exodus of funds from Magnificent Seven ETFs is complex and multifaceted. To fully grasp its implications, we need to delve beyond the surface-level headlines and explore the underlying factors driving this shift. Here are some key considerations. 1. Unmasking the bubble fears. Growth at a crossroads. The meteoric rise of the Magnificent Seven was fueled by explosive growth. However, investors are questioning the sustainability of this hyper-expansion, particularly in light of maturing markets and increased competition. Valuation disconnect. Valuations of many tech stocks have become detached from their underlying fundamentals, exceeding reasonable price-to-earnings ratios. This raises concerns about a potential correction, leading investors to seek safer havens. Macroeconomic headwinds. Rising interest rates and inflation pose a significant threat to growth-oriented companies like those in the Magnificent Seven. Higher borrowing costs can hinder expansion plans and dampen investor enthusiasm for speculative bets. 2. The diversification imperative. Breaking the monoculture. Over-reliance on a handful of stocks exposes portfolios to significant downside risk. Investors are now seeking to diversify their holdings across sectors, industries, and asset classes to mitigate volatility. Thematic appeal. ETFs focused on themes like clean energy, cybersecurity, and healthcare offer exposure to high-growth areas less susceptible to a tech-specific downturn. These themes tap into megatrends shaping the future, appealing to long-term investors. Active management regains favor. In volatile times, the expertise of skilled fund managers becomes crucial. Actively managed ETFs, which dynamically adjust their holdings, offer investors a more nuanced approach compared to passively managed tech-heavy funds. 3. The tech sector reckoning. Growth correction or paradigm shift. The current exodus may be a temporary blip, or it could signify a more fundamental shift in investor sentiment towards the tech sector. Technological innovation remains vital, but investors are likely to demand evidence of sustainable profitability and responsible growth. Winners and losers emerge. Within the Magnificent Seven, individual companies with strong fundamentals and clear growth trajectories could weather the storm. Conversely, those relying on hype and unsustainable business models may face significant challenges. Innovation beyond the usual suspects. The focus may shift towards emerging players in cutting-edge technologies like artificial intelligence, blockchain, and quantum computing. These areas offer high growth potential, while being less exposed to the immediate concerns surrounding the established tech giants. 4. The long-term impact. Reshaping the ETF landscape. The decline of tech-heavy ETFs will likely drive innovation in the ETF industry, leading to the development of new products, catering to diversified investment strategies. Tech sector transformation. The reduced inflow of capital could force tech companies to prioritize profitability and long-term viability over short-term growth and hype. This could lead to a more sustainable and responsible tech ecosystem. Investor education and vigilance. This episode serves as a valuable reminder of the importance of due diligence and diversification in investing. Investors must be mindful of potential bubbles and understand the risks associated with concentrating their holdings in a specific sector or group of companies. The bottom line here. The shift away from Magnificent Seven ETFs is not just a temporary market blip. It represents a fundamental reevaluation of risk and reward in the technology sector. While the full implications remain uncertain, this trend is likely to reshape the landscape of both the ETF industry and the tech sector itself. Investors must adapt to this changing environment by embracing diversification, seeking alternative growth opportunities, and maintaining a critical eye on valuations and underlying business fundamentals. By going beyond the headlines and understanding the deeper forces at play, investors can navigate this dynamic market and build resilient portfolios for the future.